The market is flooded with noise. Our only job is to find the signal. Let's cut through the clutter and pinpoint 3 actionable situations that are developing right now.
Look, if you're getting whipsawed by headlines, you're doing it wrong. The only thing that matters is the data that actually creates opportunity. So we're going to ignore the noise and focus exclusively on that signal.
All right, let's start with the political noise you can't ignore. We're on day 24 of the government shutdown. Now, what's new here? Well, the betting markets are now pricing this thing to last well into mid-November. And that means a sustained, predictable drag on the economy.
Okay, now for a hard signal, the 10-year Treasury yield, the benchmark for pretty much everything. It is holding the line at that critical 4% level. What does that do? It pulls mortgage rates down and puts some serious pressure on the Fed to think about a pivot. This is a level you absolutely have to watch.
And here's a dislocation that's screaming from the charts. Adobe, down 27% over the last 12 months. And yet, what's the company doing? Executing flawlessly. This is a major disconnect between the story the market is telling and the actual numbers. And yeah, we're going to break that opportunity down.
So what's driving all this? It's really a perfect storm, right? You've got fiscal gridlock here at home, global trade friction creating uncertainty, and a massive inflation report coming up. That mix creates volatility, and for us, volatility means opportunity. All right, let's get into the specifics on the macro risks. First, the shutdown isn't just political theater anymore. It's threatening air travel and supply chains. That's real. Second, those US-China talks next week, that's a binary event for a lot of sectors. It's going to move things, one way or another. Third, the US-Canada talks just stopped. That injects a level of geopolitical risk nobody was pricing in. And to top it off, Russia's shadow fleet is basically putting a floor under oil prices, which just makes the whole inflation picture that much messier.
Okay, these are the dates you need to circle on your calendar. This week, it's all about the US-China meeting. After that, the CPI report. That's what's going to tell us what the Fed does next. Then, around November 11th, Adobe reports earnings. That's a huge test for the whole AI narrative. And then, mid-November, that's when the shutdown could really escalate. Mark these down.
So what's the takeaway from all this pressure? It creates opportunity. It creates these pockets of dislocation and mispricings in the market. We're going to dive into 3 very specific situations right now.
Right, so we're seeing these intense battlegrounds pop up in 3 key sectors: healthcare, tech, and semiconductors. In every single one, you've got this powerful market story clashing head-on with the actual fundamentals. And that's exactly where we hunt for trades.
Okay, healthcare. Look at what happened to Molina. The stock just got hammered after earnings, dropped about 20%. Why? Their medical care ratio absolutely blew out to 92.5%. To put that in simple terms, for every dollar they bring in, they're paying out almost 93 cents in costs. That's a business that's not working. Now, management's fix is to jack up rates by 30% and ditch unprofitable markets. It's aggressive, but it's also the basis for a potential turnaround play. And it's a huge red flag for their competitors, by the way.
Now for tech. Adobe is the perfect example of narrative versus reality. The stock is down 27%. Why? Because the market has this story in its head that generative AI is going to destroy their business. But then you look at the numbers. $23 billion in trailing 12-month revenue. They just had a double beat and raised guidance, and they're buying back their own stock aggressively. This battle between the fear narrative and the hard data is going to come to a head around November 11th.
And then you've got the semiconductors. With Micron, the stock is up a staggering 146% year-to-date. So the question is simple. Is this a real AI supercycle, or are we just at the top of another classic semiconductor peak? The bulls will point you to a forward PE of 12.5 and a PEG ratio of 0.2 and say it's still cheap for the growth. But the bears, well, they'll point to history. This industry is notoriously cyclical, and this parabolic run is priced in absolute perfection. There is zero room for error here.
Okay, before we get into the specific theses, just the mandatory disclaimer here. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. So please do your own research. This is not financial advice.
All right, so how do we actually position for this? Let's break down the bull and bear cases for these 3 names. We're looking for clear, data-driven theses with defined catalysts.
First up, Adobe. The central conflict here is a crisis of confidence, not a crisis of performance. The market is scared of AI. So the question is that fear justified, or is this just a massive mispricing?
Okay, here's the 2-sided coin. The bull case is simple. This is a value opportunity. The stock is fundamentally cheap, earnings are strong, and management is executing. The AI fear is just noise. The bear case? The stock is a falling knife. The market is right to be scared, and the current financials are just a lagging indicator of the disruption that's coming. The earnings report will be the moment of truth.
Next, Molina. This entire thesis hinges on one thing. Can management pull off their 2017 turnaround playbook again? They're talking about aggressive rate hikes and exiting bad markets. It worked before. The question is, will it work this time?
So for Molina, the bulls see a classic turnaround play. They're betting that the problem is temporary, it's isolated, and this management team knows exactly what to do. The bears, on the other hand, think the pain is here to stay, that healthcare costs aren't coming down, and the rate hikes will just cause them to lose customers. This one is a bet on execution versus a bet on a broken system.
And finally, Micron. This one is about as straightforward as it gets. The conflict is whether this AI-driven demand is a permanent secular shift or just another boom before the inevitable bust in a deeply cyclical industry.
The bull case for Micron is this time is different. It's an AI supercycle, a structural shift in demand, and the low PEG ratio means it's still undervalued even after this massive run. The bear case is that history rhymes. The 146% run-up has priced in perfection, and any small miss in guidance will trigger a very sharp correction. This is a bet on a new paradigm versus a bet on historical patterns.
Okay, so let's move from theory to practice. How could you actually structure a trade to express one of these views? Again, these aren't recommendations, just frameworks for thinking about positioning with defined risk.
All right, let's take Molina. If you're bullish on that long-term recovery, one potential structure is a cash-secured put. You'd sell an out-of-the-money put, maybe 30 to 60 days out. Why? You're collecting premium from that elevated implied volatility post-earnings, and it does one of two things. Either you just keep the premium if the stock holds up, or you get to buy the shares at a lower price if it drops. It's a way to get paid to wait.
Now for the Adobe earnings event. This is a high-risk event, so you want a defined risk structure. A bull-call spread makes a lot of sense here. You'd buy a call and sell a higher strike call against it, with an expiry just after the earnings date. The rationale is simple. It caps your maximum loss to the premium you paid. So if you're wrong, you know exactly what you stand to lose. But if you're right and the stock rallies, you get leveraged upside.
And to wrap up, the final disclaimer. This is not trading advice. It's just a market update to keep you informed. All markets carry risk. Always trade your own plan, manage your downside, and verify all the data yourself.